Kunal Vora, who's joining us, head of India Equity Research at BNP Paribas. Kunal, afternoon. Thank you so much for your time. First of all, very good name, a pricey paradise. How nicely have you named your report this time round? So, is that a challenge you and your team members also facing in your conversations with your clients as well? Because they like India for a variety of factors with a big list, but actually valuations are pricey. So is it working harder and getting to identify names which are still attractive and risk reward?
Yeah, hi Ajay. Thanks for having me on the show. I think you said it right. That's the struggle. If I think about India fundamentally, there is absolutely nothing wrong. You look at strong GDP growth rate of 7%, CY23, next year again 6.5%. You have very strong local flows coming in, almost $2 billion. FII flows also have been super strong after $17 billion outflow in 22. You saw almost $21 billion inflows which came in. If I think about earnings, again, very strong earnings, consistent double-digit delivery in FY23, FY24, and even FY25 looks like another strong year with mid-teens growth. If I think about global factors, again, looking very interesting with Fed rate cuts, which should be positive for emerging markets. India is going to be included in emerging market bond indices, so there should be some support for the bond yields. So most factors which we can think of have really been very positive for the Indian markets. But issue is that that's getting priced into a great extent. When we think about valuations, valuations is where our concerns are. And it's becoming increasingly difficult to find stocks which are offering growth at reasonable valuation. The metric which we like the most is the gap between bond yields and earning yield, and that's been a fairly accurate predictor of future returns. In the past, whenever we've seen this level of gap between bond yield and earning yield, historically the returns have not been strong. So we've seen this in 2010, 2014, 2018. 2022 was an exception, but again, like say, bond yield earning yield gap is upwards of 2%, which makes us a little concerned about valuation and near-term returns.
That you're actually expecting only high single digit return on the index level because of this argument. Does it also apply to a broader market as well, or largely the large caps would give likely to give those kind of returns, but broader markets may offer a slight alpha over that?
In fact, our view is different. We believe that like what's done much better compared to the broader market, like, compared to the Nifty, is broader markets. We've seen mid cap index giving almost 45% returns in CY23. Small caps did even better, upwards of 50%. Nifty was, on the other hand, like lower at 20%. We believe that this could be a year in which you could see higher returns from Nifty compared to mid and small caps, which would imply that mid and small caps could see consolidation during the year.
So there could be consolidation in the broader markets. Hi Kunal, this is Anisha joining the conversation as well. I understand that your Nifty target for the end of the year is around 23,500, a 10% move from here. But for that to happen, you of course have to make sure that financial sector moves as well, right? And the private banking names have been the key underperformers. What do you think what do you think the sector needs as a trigger, and why the underperformance?
Yeah, that's the like place which we see value in right now. Financials have, especially private banks, have got like the best fundamental in decades. We've seen very strong credit growth, which is sustaining. There has been concern regarding the margins, which have disappointed a bit in recent quarters, but we believe we are coming to the bottom of that. And in FY25 and more so in FY26, we see a fairly strong earnings rebound. And along with attractive valuation, strong corporate balance sheet, strong bank balance sheet, very reasonable valuations, and improvement in margins going forward, it might take a couple of more quarters. But I think banks are well poised for a fairly strong year. And like that's where we see value right now.
Out of all the sectors which you track, which ones would you have the highest amount of earnings growth over the next 12 to 24 months in your view?
So over the next 12 to 24 months, I think banks is one sector which should do well. Broadly, consumption as a theme, I believe would be fairly weak. In IT, we believe there could be a turnaround. IT is close to getting bottoming out, and we believe that IT could start seeing a recovery in earnings. And industrials, defense, etc., these stocks could continue to see fairly strong earnings growth. Having said that, in certain cases, while earnings delivery might still be healthy, we believe that the valuations have already moved ahead of fundamentals, and there might not be a strong correlation between earnings and valuations across sectors.
Kunal, there seems to be a bit of an anti-consensus call on pharma and IT. Pharma, you're actually worried about, so you're underweight there, where the rest of the rest of the experts are actually moving towards it. And IT, you do prefer. IT, I understand, could be a value case, but why not pharma?
Yeah, in pharma, like we are selective. We like healthcare, we like diagnostics, but in pharma, we believe that generics right now, whatever growth we are seeing, is being driven by one-off opportunities. So pharma generics, US generics, not really doing very well. Even the Indian pharma market, the growth rates are still in high single digits, which is good but not great. In that context, where the valuations are and the kind of year which you had in 23, pharma had a fairly strong year. We believe that this sector could be an underperformer in 2024.
Within pharma, diagnostic and hospitals is something which you are positive on. I want to understand, are you not facing challenges in looking at hospital space? Because sure, one can say that the representation of hospitals in the market is only going up now, almost half a dozen new hospital stocks available. But still the bigger ones, the leaders are still trading at premium valuation. So is it also do you like that space? Are you open to coming down the market cap curve in hospitals, or you'll stick to the big ones?
Yeah, I mean, like say in certain cases where the opportunity is large and pharma, like say hospitals actually happens to be a part of our affluent India play, we are okay to pay up. I mean, while we prefer growth at a reasonable valuation in certain sectors where there is opportunity for higher level of penetration, there is opportunity to expand business, and the structural growth story is strong. In that case, we are okay with the lower market caps as well as the fairly like high valuation multiples.
On that note, we let